Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Balancing Scale and Service, Mike Durbin on Growth and Cetera's Future. It's a conversation with the CEO of Cetera Financial Group. I'm Jason Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
With 35 years in the industry and leadership roles at Morgan Stanley, Fidelity, and now Cetera, Mike Durbin has a rare panoramic view of the wealth management landscape. He's seen firsthand the evolution of the independent ecosystem, the rise of private equity in the space, and the shifting priorities of both advisors and their clients. Since joining Cetera in 2023, Mike has been leading the firm through a period of rapid expansion, balancing the scale and resources of a national platform with a boutique-level advisor experience. From multi-channel affiliation models to tech and AI integration, his strategy is about one thing: helping advisors grow faster, smarter, and more sustainably. In this episode, Mike and I discuss the role of a $600 billion plus firm in the industry landscape. He shares how Cetera is competing and often winning in a crowded field of well-capitalized peers. Mike offers why the firm's big feel small approach is a core differentiator. Plus, we talk about the role of technology in driving efficiency, personalization, and capacity, and how private equity backing shapes strategy and long-term opportunity, and much more. Whether you're a growth-minded advisor, a tech-curious leader, or simply interested in how large firms are positioning for the next decade, this conversation offers a clear-eyed look at what it takes to thrive in today's wealth management arena. So let's jump in. Mike, thanks again so much for joining us. To start with, can you just walk us through your background? And you've played key roles at Morgan Stanley and Fidelity. If you could touch on those as well, that'd be great.
Sure. Happy to, Jason. Great to be with you. Amazingly, I'm in my 35th year of working in and around this industry. As you said, I'm currently in my 3rd firm, but there's been a lot of changes along the way. I started coming out of undergrad 35 years ago into, at the time, Dean Witter's investment banking division. The group I was in was really a product origination, a product syndication group. We were creating, diligencing, and bringing to market product that was sold through the Dean Witter financial advisor base at that time. When Dean Witter and Morgan Stanley merged, I went into different roles in the then merged Morgan Stanley. I'd say the last 10 years of my time at Morgan Stanley was in various management roles in and around the wealth management business, primarily in the US, but also outside the US. After those 18 years at Dean Witter and Morgan Stanley, spent 14 years at Fidelity, and have just crossed 2 years at Cetera.
Good for you. It's a great story. And I think a part of you must be a little bit, I don't know if bitter is the right word, but when you tell that story, you must laugh a little bit thinking back, because in 2009, to join Fidelity, nowadays people say, oh, good move. You joined Fidelity, one of the largest RIA custodians in the space, massive name. But at the time, people were singing a very different tune about the industry landscape, about the independent space. What did you see that others didn't in 2009 that led you to believe Fidelity was the right trade over a known entity like Morgan Stanley?
Yeah, it's a great question. I certainly didn't see anything that others didn't. I'll be clear on what I saw, and maybe I was earlier than average, but I was not alone. Really, the confluence, Jason, of three really closely connected things. One is being part of the management team of the Morgan Stanley Wealth Management business. We would do a deep dive on the RIA industry a couple of different occasions in my latter years at Morgan Stanley. Just we were watching the tea leaves, we were watching the flow of ACATs, we were watching some advisors leaving Morgan Stanley to take this RIA form. And so, as a good leadership team, we wanted to be smart. What's going on here? So, I was charged with a strategic review of the RIA segment, would be sort of factor one. And it was clear that something was going on there. Factor two was, as part of that review, it was clear the ecosystem being brought to bear to support RIAs was absolutely exploding. From the custodians, the portfolio accounting providers, to the managed account platform, CRM, the space, it was pretty clear that, hey, there's a serious ecosystem of capability sets that is emerging rapidly to allow RIAs to do pretty sophisticated business. This was well beyond financial planning with wrap asset allocation, mutual fund portfolios as the only solution. It was getting pretty sophisticated. And then the third, which is the direct outcome of the prior two, is I was watching larger and larger teams go into RIA form, in particular, a couple of really large, notable Morgan Stanley teams at the time that went out to take this independent RIA form. It was just really clear to me that there was a significant leg of growth ahead of the RIA sort of form of wealth management, just given those three factors. Never at the expense of the wirehouse. Here we are all these years later, and the wires are doing just great. Morgan Stanley's a terrific firm, a terrific growth trajectory. But what's clear was there was a secular shift underway to the positive for the RIA affiliation.
Yeah, I think that's really well said. It became emerged into a world where the wirehouses were once the only option for sophisticated ultra high net worth teams. And they are absolutely still a very viable option for those teams. But I think what you're alluding to is they're no longer the only option. And you're being modest, but it did take a tremendous bit of foresight and forethought to realize that in 2009. Because, like, I'm reminded, I don't know if Rob Sechin, one of the founders of New Edge, but Rob told a similar story about he was at UBS and they tasked him with running down what does an independent channel look like? And it just was eye-opening to him. He said, holy cow.
For sure. And even in my earliest days, Jason, at Fidelity, when I would help the team with business development, with selling, and an archetype you and your family knows quite well, a wirehouse breakaway that's considering taking RIA form. In those early days, we at Fidelity and the other big custodians would often have to explain away the gaps that team is going to experience by leaving a wire and going independent in RIA form. I'm telling you, within 18 to 24 months, the gaps were emerging in the other direction because this ecosystem had exploded so materially and the bigger teams were coming out to take independent form. Soon there was not a product provider, trading desk, syndicate calendar, trade type, account type, reg type that you could not enable or facilitate in RIA form. And I think those gaps have stayed in place since. So it's been a really exciting run.
So that's fair. I'm getting ahead of myself here, but I just want to push back a little bit if I can on one point that we hear from advisors, which is all of that is true. The RIA space has caught up or even moved ahead of the traditional firm space. And I agree with that, I think, in every area except for brand. How do you address that as somebody who's been, I think, one of the kind of legends of the independent space? How do you, I'm sure you've told the story of independence a million times. How do you tell a Morgan Stanley or a UBS advisor, yeah, I know you're walking away from one of the top 3 brands on the planet for a name you and your clients probably aren't going to know?
Well, we can broaden it to any brand, right? Any sort of national brand beyond just Morgan Stanley. But to me, the question is pretty simple. How often are you utilizing that house brand to build and retain your book of client households? More often than not, fast-growing, large-scaled advisors are building a great business on the back of their own brand, their own value proposition, availing themselves of incredible resources and service and capability and connection points through their provider. But ultimately, it's part of why I came to Cetera. I want to invest behind the thousands of brands that are at work across the Cetera advisors day in and day out across the country. We invest through their brands. We have to be a good, stable, high integrity, high resiliency provider and scale provider, but we're investing behind their brands. And because industry study after industry study, good market or bad, clients follow their advisor 8 times out of 10 more stringently than the firm through which that advisor affiliates. So we need to stay invested behind that advisor and that brand.
You just alluded to this, but what did draw you to Cetera at a time when, I mean, you could make the case, certainly Fidelity, one of the premier players in the independent space. So what drew you
For
to
sure.
Cetera?
For sure. What drew me to Cetera, twofold. Again, maybe it's two sides of the same coin, perhaps, Jason. But one was I really did have a yearning to get back on the side of the table with advisors. I really enjoyed my time at Morgan Stanley, saw a lot of change, a lot of growth, a lot of evolution, some disruption at Morgan Stanley. Can't say enough about my experience at Fidelity, but in that role, I was a service provider more than anything else into those independent or even wirehouse advisors, depending upon the offering that Fidelity was bringing to bear into that financial advisor broad space. But I really had this yearning to get back on the side of the table of advisors. Maybe we'll get into this more. I just deeply believe there's an incredible decade of growth and change ahead of the US wealth management business, and felt that I really wanted to be aligned with a situation that would best position me and the firm that I joined to take advantage of that really exciting decade that I think we see ahead.
Yeah, so we'll absolutely get there. Indulge me. Let me ask one more question in the
Please.
rear view. You mentioned the proliferation of the support ecosystem is one massive change you saw in the last several years as it relates to the independent space. Can you name me one other, or give me a couple of other kind of seismic shifts you've seen if you think back to, let's say, 2009 versus today?
I'll give you two, perhaps, Jason. One is, and I should have said it earlier when defining the components of this exploding ecosystem, external professional capital was a clear new entrant into an accelerant into this space. By the way, that capital invested in the ecosystem providers, venture investing into wealth tech or fintech, or private equity behind some of these more platform providers that many in the industry rely upon. But the capital obviously came directly into the RIAs, broker dealers, insurance captives, you name it. And that is a relatively recent phenomenon in the historic context of the industry. That's one. Two, Jason, I would say is, again, when I was making that transition many years ago from Morgan Stanley to Fidelity to run the RIA custody business at Fidelity, it was a reasonably binary world still. You were either the only RIA or you were traditional independent broker dealer, probably still transaction leaning on your way to being more advisory. And that is long gone. I'm just a very staunch believer. I voted with my feet that a long-term hybrid embrace, a hybrid model rooted in financial planning for a domestic household is the winning value proposition. It's less binary than it was. And I think that's a great outcome for the industry because there's this growing range of business models, affiliation models, legal structures that a wealth manager or wealth management practice can take. And that's great. I think that's a good thing for the industry. It's not you're either a black or a white or a Hatfield or a McCoy or a fee or commission. It's hybridizing and there's more variations, which is a good thing.
Yeah, well, there's no question the lines are blurring. There's no question also that, look, the reality is advisors have more choice than ever. So I think that has spurred firms to also say, we need to blur the lines because that's what advisors want. Like an advisor doesn't want to have to say, I'm a broker dealer advisor.
You got it.
You touched on value prop, and I want to ask you now, you mentioned some components of the value prop, but not all of those are unique. I mean, it's a crowded landscape, which is a good thing and a bad thing, obviously. But can you talk about now Cetera's value prop in the marketplace as you tell it to advisors? Maybe touch on a couple of things that you think make the Cetera story unique. And if you don't mind, also provide some context around size and scale of the firm as well.
Sure, happy to. When we go to market to welcome a new advisor, a new team, a new large enterprise to Cetera, we really lead with this notion of Cetera makes the big feel small. So we play up where we're big, where it matters, because scale matters in this business. But the real distinguishing element of the value proposition is how we make that big feel small. And we make that big feel small because we go to market and we resource behind our commitment to channels and communities. We go to market through 5 channels, and under each of those channels will be one or more dedicated communities. And that allows us to go to market if we're doing the consultative selling the right way, usually in partnership with Diamond Consulting. We're doing the consultative sale the right way. We're going to make sure the first decision is the channel. Where does a particular practice fit? In our independent practice channel, the large enterprise channel, our tax channel, our bank channel, or our RIA and branches channel. That 5th channel is our newest. Once we determine that channel, the dedicated community under that channel into which we would like to steer a particular prospect is going to be driven by where does that prospect feel the most affinity? The affinity in their approach to the business, the affinity to how they go to market. And again, we've really met with a lot of success there, and it's accelerating because it is differentiated. And I referenced it quickly, Jason, we can go back through it if you'd like, but that's not just an org chart construct. We have resourced Cetera along that channel and community dimension. We push seniority, accountability, decision rights, responsiveness, flexibility out to the channels and communities. So again, that's that big feel small. So that if you're a practice in a particular community in one of our channels, you can go to your direct coverage or your direct community leader and get a decision because that community leader has been empowered to do so. Now that community leader can turn to the enterprise scale that Cetera brings to bear day in and day out across all those channels and communities. But we do our best not to expose all of that scale to all 12,000 advisors day in and day out. They see Cetera through the affinity they take advantage of in their community. And we think that is very differentiated. We know it's differentiated relative to how some of our more direct competitors have resourced and arrayed themselves and how they go to market day in and day out. Cetera's scale by rough metrics, the rough proxy, we are just under 12,000 advisors. We're just under $600 billion of aggregate assets under administration, and roughly $265 billion of that almost $600 billion is advisory assets, or what we would consider assets under management. That's a pretty reasonable growth rate over the last couple of years because in addition to good organic growth, we've also done a number of fairly material M&A transactions that have brought a lot of scale quickly. And we really feel great about how we're positioned to continue to build momentum.
Yeah, so it strikes me as you go through and I'll ask you some follow-ups on the various affiliation channels and how you guide advisors through thinking about that, because I know that can be a lot for advisors to digest. But what strikes me there a little bit is you are walking the tightrope, I think really masterfully, between scale and size, the need for scale and size, but also the idea that most advisors, if you really ask them, would prefer a boutique or like that kind of elite experience. And the challenge that we've seen a lot of firms in the space walk is a lot of the firms that touted the boutique element. I don't know if you heard, there was quite a large broker-dealer acquisition this year.
I'm vaguely familiar.
Right? So the ability to say we have 12,000 plus advisors, we're not going anywhere. I imagine that's a big part of the story, even though it's about delivering advice in a boutique-ier way or servicing advisors and therefore servicing clients.
For sure. You got it. I tend to joke often, Jason, that I've been around advisors a very long time, and most advisors I've ever met want to be part of a scale resource-rich organization, but as soon as they enter, they want to close the door behind them, right? There aren't many that say, boy, I dream of the day when I can work in an organization of 20, 25, 30, 35,000 advisors. They do want the scale. They do want the resources, and they want and need the expertise. And that's what's really exciting about the leg of growth that Cetera is stepping into now because of the scale that we've assembled. It's not just driving down unit costs so that we can share that value with advisors and their customers. We are. But it allows us to bring on a set of capabilities and subject matter experts that partner with our advisor practices to go after business that previously they might not have been properly equipped to pursue. And we are just getting going there, and that we're really excited about the potential that we're seeing there. And some of that came through our M&A strategy. We do large scale transactions like buying a Vantax and a take private transaction at the end of 2023, or the wealth management business of the Securian life insurance business. But we also do capability acquisition. So we bought a trust company. We bought an insurance broker's general agent so that we could step in and be part of the contracting with insurance carriers and have a wholesaling role. And so it's that direct capability and skill set and expertise is really what's beginning to resonate with our advisors, that we're living into our promise to be their growth partner.
I'm curious, did those ideas come from your advisors? Were you hearing from advisors, hey, there's a gap here in our, whatever the two examples you just gave were, and therefore you went out to market and said we should address that?
It's both listen and watch. Yes, we hear from our advisors all the time. We have a sophisticated voice of the client program, but we also have, as many firms do, a fairly complicated network of advisory councils that we rely upon. Some subject matter specific councils all the way up to our most senior advisor engagement council, a client advisory board. So we're always really paying careful attention to what they're saying, but we're also just watching what they're doing. We're watching assets and relationships go to, in this example, third-party trust companies, where it's like, well, wait, we should be able to step into that because we have the scale and the ability to be an administrative trustee, et cetera, et cetera. So it's listen and watch. All senses are firing.
No, that makes sense to me. But before I forget, I don't want to lose the thread on the affiliation channels because some firms come to market with multiple affiliation channels and they tout all the benefits, advisor choice, client choice, more freedom to do XYZ. But the reality is it can lead to some confusion, I think, among advisors. So what is your process for determining? I imagine there's some more that are pretty obvious, like you're a bank advisor, you belong in the bank channel. But what is your process for determining where an advisor fits within the Cetera ecosystem?
Yeah, it's a good question. For the 5 particular channels, it's easier than you think because, again, the channels are an independent practice channel we call Cetera Advisors. That's juxtaposed to the second channel, which is our large enterprise, or sometimes the industry calls the OSJ channel. That's firms within the firm. So you either are a large enterprise principal, or we're recruiting into an existing large enterprise, or you're an independent practice. That's pretty clear. Beyond that, it gets even clearer. Are you a tax-based professional, either affiliated with a CPA firm, have a particular tax sort of orientation to your practice? Are you in a bank, or are you after our RIA or supported independent value proposition, our Cetera Investors branch system? So it really is easier than one might think because the channels are fairly distinct. What I would share is that you referenced, and we've been on the offensive side of this as we are now, we've been on the defensive side of this. When a large firm goes through an M&A transaction, it's a bit of a jump ball. There is a term for it. Sorry for the sports analogy. In our actions, our activities this year against a particular opportunity, I can hand on heart say we have prospective advisors from one firm resident in the pipelines of all 5 of our channels. That is distinctive. That is not, hey, I know you're doing all this crazy kind of business over at Acme Wealth. We have a duplicate Acme Wealth over here. It's taking someone that had a specialized practice at Acme Wealth and putting it into a channel through which that practice is going to find immediate affinity, synergy, best practices, people that go to business, go to market just like me, and it's really having a terrific impact. So having that optionality available to us, but more importantly, allowing us to resource each of those channels and the needs that are unique to those channels is what really the advisors see as the distinct difference.
Yeah, no, I appreciate you clarifying that because even just hearing you say it a second time, I can see what you're saying, where there are some clear fits there. This is a credit to you. My next question here, I want to talk, when I think Cetera, the first thing I think subliminally almost is growth. And I think that probably touches on all of these various channels. It's probably a good time to ask you, tell me a little bit about why is growth so important to Cetera? How do you help advisors to grow? Do you mean it? Tell me about the growth guarantee. Fill in some of those gaps.
Yeah, for sure. Our embrace of growth is real and it will be enduring. The industry extraordinarily well. We are very profound believers that if you help a practice grow, you'll have them a long time. I think growth trumps everything. Yes, you need good service. Yes, you need good technology. Yes, you need good expertise against a particular subject. But if you're really driving a reputation with a practice that, boy, I wouldn't think of going to market without the growth resources of Cetera, I think you've really got something. So we're quite serious about that. Why else are we focused on it? Fundamentally, because the growth potential is there. There are still way more US households that would love to avail themselves of the services of a human advisor than there are human advisors able to reach down and handle all this demand. So we just see a great addressable market there. It's as primal as that. But it means that for the industry's reasonably fixed number of advisors that you know well, over the past decade, the industry has not added a lot of net advisors. If we're going to tap into that demand pool that is there, practices have to get more and more efficient. They got to rely more and more on partners. They got to be open to outsourcing elements of what they used to do themselves if they are serious about themselves trying to put themselves on a growth trajectory and drive their own enterprise value. That's the kind of practice that we're looking for. They see the world the way we do. They're willing to embrace new technologies and new capability sets to open up capacity so that they can drive growth out of this addressable market. It's not easy, don't get me wrong, but it is there. But it may involve changing your approach. If you're tied to a desk running money day in and day out, that's a great practice. There's nothing wrong with that. It's going to be really hard to free up cycles to fundamentally take on a new addressable market to try to get some step function growth. That's where we try to partner with the growth firms. And that's where our partnership is being seen by the growth firms. They see the difference that we're bringing there.
Tell me more about what that entails in practice. When you say partnership, is it like a coaching sort of process where you're almost guiding these advisors to say, we've seen the secret sauce. We have respect for what you're doing, but with respect, we believe our way is the better way or the way that will lead to more optimal growth. You should consider adapting ABC.
Yeah, it's a really great call out, Jason, because one of the least covered elements of any firm getting scale, the most valuable part of scale is we have best practices. We're not alone here, but it is the large scale firm that really has a good command on what good looks like and what less good looks like. I mean, so the best practices of our best firms is one of our most valuable currencies. Now, we can't just post that on a website or push it in an email. We have fundamentally organized and resourced out these channels and communities with precisely that capability set. So to answer your question, how do we fuel growth? We call them regional growth teams. We will assign a regional growth team to a particular practice or set of practices. And that relationship starts on the basis of building a joint multi-year business plan. Cetera wants to have skin in the game in the business planning and the accountability around the execution of that plan with the advisor practices that we're serving. And so you draw that kind of accountability based on a plan, heavily quantified, measured, so that we have joint accountability. And again, we're aligning the resources out so that regional growth team can make the decisions, bring in the subject matter experts, bring in third-party partners and sponsors that they think is going to actually help those practices that they're responsible for covering, going to put them in the best position to hit those long-term growth goals. We're so confident, we're so serious about this. We went to market with a growth guarantee. And not to quote Tommy Boy script here, but I'm delighted that we did and it's working. And why did we do it? Because we could. Because we had empirically shown ourselves over market cycles that those firms that fully engaged our approach to growth and maximizing value and being really efficient, they were seeing the materially faster growth rates than those Cetera advisors that did not. We're just trying to draw attention. We're serious about this. We want to be your growth partner, and we're putting our corporate skin in the game to try to help manifest the sense of urgency that we're putting behind it.
Yeah, I think that would resonate with me if I were an advisor, especially if I were a younger and hungry and growth-oriented advisor. The idea that you're putting your money where your mouth is, I think would resonate with me. And I'm curious, kind of to that end, I would imagine, you can correct me if I'm wrong, but your competitor set, you're coming up against the same handful, call it 10 firms often. When you're going up against the LPLs, the Ameriprises, the Raymond Jameses, to name a few, is that a part of what you're leading with is, hey, those are great firms, but our growth is unparalleled?
For sure. Look, we lead with a few things we've already talked about. We lead with, we're here to make the big feel small. We lead with, we're going to array the resources you need right out at the line of scrimmage where you're operating, Mr. and Mrs. Advisor, day in and day out. And we're going to have joint accountability, that joint skin in the game with you by aligning those resources that way. And 3 is, against those names that you highlighted, we're private. We move faster. We move more efficiently. We move with conviction. We are accountable to a very narrow but engaged set of stakeholders, of the holders of our equity. And yes, we are private equity backed, and we have Genstar Capital as a principal sponsor that holds the lion's share of that equity. But we have nearly 2,000 holders of the equity beyond our private equity sponsor, and that includes management and advisors. And so when you can be private and have alignment with your top practices around the long-term value creation of the firm, you get a lot of operational advantage of what you can do at pace. So we feel really good about how we're positioned there.
It's a great answer. And I want to talk a little bit more about the ownership structure. But before we do, I want to talk about, you mentioned briefly technology as a component of, I don't know if we call it the secret sauce, but a component of the sauce nonetheless. Where do you view, well, two-part question, I guess. First and foremost, tell me about the tech platform. Do you view your technology as market competitive, excellent? Are you investing in it heavily? And then my second question would be, kind of where do you view the puck heading in that space as it relates to Cetera?
It's a great question. Could be the subject of its own podcast, but I'm very pleased with our approach to technology for sure. But look, this is advisor-facing technology, which means you're never done. No one's ever done. It's never like, okay, we got a 3-year investment program on the tech and then we're going to be okay. We keep up, again, benefit of scale. We keep up a high, persistent level of investment year in and year out bull market or a bear, because we're private, with an ownership group that knows how to create long-term value. We're constantly investing behind our technology. The simplest way to describe it, Jason, is that Cetera, in a very differentiated way, we have our AdviceWorks core technology value proposition. That's the core advisor and end customer facing technology, both desktop and native mobile app. It sits at the other extreme. It sits on top of a multi-custody, multi-clearing platform, including Cetera's self-custody, self-clearing. So we're the only large firm that has multi-custody, multi-clearing, including our own. And we mask that, if you will, by having our AdviceWorks core technology platform sit on top of those. Now, why are we doing that? We have an approach of multi-custody, multi-clearing, including our own, in order to have the maximum addressable market for our growth. One of the key elements of friction in any practice making a move will be, well, do I have to change clearing firm or custodian?
Paper. Yep.
So we have scaled footprints with all the usual suspects of the large clearing and custodial providers, where we try to minimize some of that friction, so maximum addressable market. Our embrace of our own AdviceWorks technology platform, what we're putting into AdviceWorks are the core transactions and functions that comprise 80% of advisors every day: account opening, money movement, maintenance, et cetera. And so we want that done in AdviceWorks so that we extrapolate all the complexity of being multi-custody, multi-clearing, and an advisor can do it in the AdviceWorks experience. What's the guiding principle of AdviceWorks? And again, it'll never be done to my satisfaction, is easy and interconnected experiences. Because between our AdviceWorks and a group of clearing firms and custodians, including Cetera, we have all the right middleware provider partners that we count on: Ryan, Envestnet, Salesforce, you name it, right? And so we are a vibrant ecosystem ourselves of the right proprietary technology for the right use cases, all the right third-party partnerships that want to work through and with Cetera, sitting atop a multi-custody, multi-clearing backend, if you will, including our own. So sorry if that's a mouthful, but I think that's a durable and bulwarked approach.
I think it's important because we hear a lot about you touched on this earlier in your remarks about what used to be, if somebody was going independent, it was the two poles. You were either launching an RIA or this like kind of captive BD, probably largely commissionable type of model. We talked a little bit about the lines blurring. It sounds like Cetera, you've really blurred the lines. Is that fair to say? Like, you don't view this as we're an independent broker dealer. You view this as we can replicate a lot of what the RIA space is about.
You got it. Absolutely fair. I should write that down. You'll be in our next brochure. You got it. So we have this expanding set of affiliation models that we bring to market and support across those 5 channels, right? And so the most recent channel is our 5th channel, the RIA and Cetera Investors branch system, our supported independence channel. And again, it's the most recent where we've hired specific subject matter expertise from outside the firm to help us come in and run that channel with an experience base. That channel already has over $30 billion of total client assets in it. So this is not a startup, but why did Cetera get into that 5th channel? And by the way, it started before I got here. Got into that channel for 2 reasons. One is existing Cetera advisors that were seeking to evolve their practice to be more RIA centric. So it's a way for us to be that forever home. You don't have to leave Cetera in order to fundamentally change. So let's say maybe you want to take an independent 1099 practice and evolve it to be an outside RIA. We can support that. But secondly, we're in the outside market, welcoming practices that are outside the 4 walls of Cetera today to come into that 5th channel in either an RIA form or in our supported independent Cetera Investors branch system. So having that optionality available is really key in this market.
So basically what it's enabled you to do, what you're saying is almost like M&A type transactions where people don't have to repaper because you say, we've already got the Fidelity relationship set up. It's a smart strategy, absolutely. I noticed one thing you didn't mention. I'd be remiss if I didn't ask. I heard it for the first time from an advisor, and I know I'm going to hear more of it. AI, not alternatives, artificial intelligence.
Yeah.
Tell me about the firm's view. Is this something you take seriously? Are you investing in it? I have to ask.
Yeah, it's all the above. We take it very seriously. We're investing heavily in it. We have dozens and dozens of use cases at work, even as we speak. And what we're doing as a leadership team is we're drawing upon AI coming to us from 3 sources. And so we're doing a little bit of air traffic control around where do we want to deploy or employ AI that's available to us. The 3 sources are our existing third-party partners that themselves are increasingly embracing AI. Think Agentforce with Salesforce or Oracle in the enterprise tech space. But in addition, Orion, Envestnet, Fidelity, Pershing, Schwab, everyone's embracing AI. We will be the direct beneficiaries of that as that AI is turned more and more into efficiency and insight for us as big users of those. So our third-party partners are a really critical source of that, and we're highly coordinated with them. The second would be, let's face it, there's a new ecosystem that's booming beneath our toes here around sort of wealth tech, fintech facing or wealth industry facing AI startups. And I wouldn't say they're a wealth alone AI startup, but in this context, our most recent announcement and partnership with Jump AI, you want to get a sense of how adoption curves are accelerating here, Jason. So Jump AI is the sort of online meeting assistant that's doing note-taking and synthesizing and highlighting action points and follow-ups. It's truly tremendous. We launched it in late spring. We're over 2,000 paying advisors already.
Wow.
That's fast. For any technology, that's pretty quick for a technology like that where the advisor's coming out of pocket. We're really pleased with that. So there's a new ecosystem emerging of startup capabilities that we're tapping into. And then third is, what are we doing on our own? And the reality is that's where we're having the most dramatic impact right out of the gate. It's around service call transcription and sentiment analysis and anticipating why someone is calling or seeking the services through email, chat, or phone, right? It's understanding just the activity going on across our platform and trying to turn that into insights of what we should be anticipating next. So that we're going to be operating, as will others in our category, of course, but we're going to be operating a little bit with this embarrassment of riches of AI can come in any, I see 3 sources, maybe it'll be 13 more over the next 6 months. We see these 3 broad sources of AI coming to us, and it's incumbent upon us to really be methodical about the sequencing. Well, we don't need to build X, Y, and Z because we'll get it from Salesforce, or hey, we're not getting it from ourselves or one of our big partners. Let's look to the startup ecosystem. Does anyone do the following? So I think we've hired for expertise here. We've hired AI-specific leaders. We hired a fundamentally new chief data and analytics officer, Kayer Desai, just joined us 2 months ago. So we are clearly all in, for sure, in the AI trajectory. And ultimately, yes, it's going to bring providers like Cetera, but even the practices that we serve, we will get efficiency. The real promise is just increasing personalization and capacity, as we talked about earlier, to take on more and do more in a highly personalized way. That cannot be a bad thing for the future of this industry.
I agree. Like, we get the question a lot and phrased as the threat of AI, but I like how you just articulated it as the opportunity. That was one element I liked of your answer. The other element I like, quite frankly, is it is refreshing, I think, to hear your approach, which is not necessarily we need to build. In fact, it sounds like it's the opposite of we need to build everything ourselves, because we see firms do that because it's either cheaper or they can exert greater control or greater profitability from it. A lot of times it just doesn't work all that well. And we've got these amazing cutting edge fintech providers. To me, the name of the game and what will make a successful firm from an unsuccessful one is not what firm can build their own technology the best over the next several years. It's who can integrate and cobble together all of these amazing tools in the right way to service advisors. Do you agree with that?
100% agree with that. You got it. Look, we didn't build our own internet in the late 90s. It just became a utility. I think it's going to happen here also. And right now, part of the rubric of where do we build or partner, part of the rubric now, but I think it's a temporal thing, is we're very protective, as we need to be, around our data and our client data. You can get a lot more capability set if you're willing to release some of your data into these other providers. We're not. The regulatory framework isn't there. Just the sort of confidence of ourselves or our advisors isn't there. I'm a firm believer it'll come. The scaffolding will come. We'll be able to do more and more of that. But that's part of what drives the need for us to do some of this on our own, because we need to protect our most sensitive data.
Makes sense. Well, thank you for indulging my AI whim there. I want to shift gears now. You talked about it, so it's fair game because you brought it up, but the private equity ownership, which can sometimes be thought of as a little bit of a dirty word or dirty words in our industry. But I think I'm just going to ask you point blank, talk a little bit about Cetera's ownership now, and how do you talk to advisors about the future is probably the more pressing question there, right? Is private equity notoriously somewhat short to medium term investment horizons? I think people fear these disruptive either IPOs or switches in sponsors or some sort of transaction that's going to be disruptive to their business. How do you talk about that?
Yeah, it's a good question. We talk about it a fair amount, as you might imagine, because we have some formidable competitors that are not private and private equity backed who like to press on that as somehow a liability for us. It's our distinct advantage is being private. And the close second advantage is, and we're private with the right partner in Genstar Capital. Yes, they're an equity capital partner, but they are a profound strategic partner for us because of their experience across the wealth management ecosystem. They either currently or formerly own Orion, AssetMark, Mercer, Cerity Partners, DocuPace, First Eagle, ACA, AmeriLife. I mean, there's not a nook or cranny that they don't have a perspective on. And so we lean heavily on their strategic counsel, in addition to them being a capital provider and the significant owner of Cetera. I mean, look, the reality is, Jason, the ownership structure of the company is not the same as who operates the company, who
Fair.
drives budgets, multi-year plans, capital allocation decisions, technology prioritization decisions, the decision to launch or sever a clearing relationship, custodial relationship. Those are operating decisions. And so what we also like to point to when we're describing Cetera in this context to folks is just look at the history of Cetera. Cetera has had multiple ownership groups over a storied past, including momentarily owned by a public holding company, right? So it's had multiple sponsors. It was part of a public holding company at one point. I don't believe there was ever a time when the change in ownership forced an operating change in the company. Those are decisions that leadership teams make. And so people like to at times cast the private equity sponsor as a boogeyman, like, oh, Jesus, private equity. So you've got to change in the future. Look, the reality is Genstar Capital and their funds that own Cetera, they're not going to own them forever. They have a fiduciary responsibility to their LPs. What I am pleased to recognize is that Genstar just re-upped their investment, re-underwrote their investment in Cetera at the end of 23. So I would submit we have the freshest capital and the longest runway of any big firm that's owned by private equity, because we are now owned by their two most recent vintage funds. So that allows us as an operating team to make decisions to build and invest in things that may have a longer return profile. And our owners are very supportive of that because they're not looking at their watch trying to exit the company right now. So we try to take the extra time to bifurcate the ownership from the operating degrees of freedom that we have. We are accountable to our owner, just to be clear.
Right.
But if there is one thing that positively surprised me among most when I came in, this company is on offense 365 days a year. Markets ebb and flow, tariffs come and go. We're good stewards of P&L and capital, but our ownership group has us with an offensive playbook only. And you can only do that if you're private, if you have a partner that is not just the capital partner, but strategic partner to see the future as we do, which is rife with opportunity. Don't be distracted by short-term market cycles. If we're doing the right thing, helping advisors grow, having a distinct value proposition, we're going to do just fine. So we're on offense all the time. And that's a pretty fun environment to work in.
Yeah, no, I think it's a very fair answer. I think when people think about private equity, it's not so much that they worry, is there going to be a transaction? It's because you could argue, right, a public company could very well be bought as well, and you're not insulated from potential disruptions just because you work for a public company. I think when people point to private equity, they typically point to, like, we know, so in your case, 2023, sometime around 2028 to 2030-ish, right? Just based on, right, you can do that back of the envelope and you start to get questions. And then something like the LPL Commonwealth transaction happens and all of this gets brought to the forefront. I mean, we get those questions now more than ever in terms of what, not just about private equity, just what does the ownership structure of a firm mean, when it was something that probably wasn't top of mind a couple of months, or as top of mind as it should be. I don't think it's a bad thing. I think advisors, if they're doing their diligence, should ask questions about the ownership structure of a firm. I would also imagine that part of this issue is mitigated in a firm where advisors are independent, right? Like, your advisors can always vote with their feet, no?
That's right. Exactly right. It's very well said. Yeah, I mean, the conventional wisdom was, it's the safest thing would be a family or founder led or controlled. Well, that wasn't a guarantee of stability, right? Much like being public at the other end, that's not a guarantee of stability either. You look over just the last couple of years, think about all the take private transactions. By the way, we were a protagonist in one of them. Avantax was public. Focus Financial, Asset Mark, right? InvestNet itself, right? And I believe this is true, Jason. What do those four firms have in common? An activist investor, where the public ownership a little bit lost control of its own destiny because it had to answer to these stakeholders and the ownership roles that of course they had to. They had a fiduciary responsibility to all of their shareholders and they had to react to that. I'm not here suggesting that is the reason that they were taken private. The point is being public is not a guarantee of the yellow brick roads only out in front of you. And so we think we're really well positioned for the opportunities available in the market right now. It is best to be private and we have the right partner through which we are private.
Yeah, I think that's really well said. And I'll say, it feels to me like that is a unique differentiator of your particular capital partner is that they allow management to operate the day-to-day of the business. I assume some of that is you earned that right at this juncture. But do you ever have moments where this doesn't feel like a nimble boutique company? Like, I guess what I'm getting at is you are still 12,000 plus advisors, plus I don't know how many home office staff. You are not a small company. So are there elements of this difficult to stay nimble and we just have to operate like a bureaucracy here?
I mean, I don't know about you. Maybe everything but the bureaucracy, Jason, but I don't think we operate with bureaucracy. We're pretty flat because we do try to stay lean as the corporate functions, if you will. We are a scale company, which means we are becoming a larger company. And so where that manifests itself is in things like, I want to go faster in AI deployments. I want to go faster in tech development and rollout. I want to go faster in embracing the incredible solution set that's growing materially, that's available to independent advisors. I like our pace, don't get me wrong. I'm usually a little impatient. Yeah, I'd like to go faster, but you have to be mindful of deploying a brand new solution will be different to a bank program client than it might be an independent practice in the Cetera Advisors Network. So ensuring that we live into the promise of making the big feel small, it's rare when one solution can work the same for all 12,000, and we're committed to making sure that the solution set works for the commitments to channels and communities that we've made.
Yeah, it's well said. This is a little off topic, but I just respect your opinion on the landscape and on the industry. And I'm thinking through like, what are the things we get asked most about by top advisors? Deals is one that comes up a lot. How do you feel about the state of recruiting deals, transition deals? And you can speak specifically to the independent space because I know it's the space you're in now. Do you feel like they're sustainable, going up, going down?
They've looked expensive every year for probably the past 5 to 7 years, and they just keep going up. And so do I think they're sustainable where we are today? Sure. The question is how many firms can actually sustain it? And I think we're on a trajectory where we could sustain it because we're growing and the advisors that join us are experiencing that growth. And so we're getting a scale effect. And so it'd be terrible to make the prediction of when will the deal crest, and because anyone that's ever bet on that has been wrong. But again, it's another check in the column of you better have scale and you better have diversified revenue and earning streams so that you can keep up the pace of investment, which includes those recruiting deals in good markets or in less good markets. And again, I'm very proud about how the leadership teams at Cetera here over the last several years has done a great job diversifying the sort of revenue and earning streams. It's pretty durable. We feel good about that. That helps support the sort of the level at which deals are being transacted these days. And that's recruiting deals, but it's also M&A. I mean, I know you track it closely. Valuations are still pretty rich. So you better have a bead on where you're going to get value if you're going to pay a top price for that. And again, we are so confident in our ability to drive organic growth through the teams we welcome or the companies that we buy, that when we choose to engage in an M&A transaction, we know how to think about value creation, and we're going to bid in a disciplined way in line with how we think we can create value. We're not going to win them all, that's for sure, because sometimes there's another irrational buyer out there, but that's okay. We stay disciplined and a good history of doing that pretty well.
Yeah, and I would posit that nobody wins them all. That's fair. I also think that's probably an element where you can position the private equity piece as a benefit, right?
For sure.
The deep-pocketed investor that allows you to stay market competitive. And when you do get the right opportunity that you want to take a big swing for, you can do so.
For sure. And look, that's they are the capital provider. It's in those potentially large M&A opportunities where they're more than a sounding board. It's like, okay, Cetera leadership team, we hear your passion, but answer these 3 questions. And you're like, oh, those are 3 really good questions. So they're a great partner when we may fall in love with something, but we have to come back to first principles, which is Does it fit with our strategy? Does it fit within a value proposition? Are we sure that we're clear-eyed about value creation and how much we should be willing to pay? It's good there. Some cases, they're the ones pushing at our back, saying, hey, I actually think there's more value here. Have you thought about the following? So it works, and they're not always just a parachute. Sometimes they're a catapult, but it's great to have that partnership there every day.
I could have this conversation all day, but I think we're coming up on time. So I'm going to ask you one more. I'll give you a two-parter so I can maximize the value for my question. A new initiative you're excited about, and tied to that, when we're having this conversation again 5 years from now, tell me what Cetera looks like.
Deal. On the new initiative, I'll start generic, but I'll get more specific. I referenced it. I'm really excited about just all the capabilities that are flooding in. There's another wave of new capabilities coming to independent wealth managers, whether that's AI, as we talked about, or crypto, or alternative investments, broad democratization of alts, but also fast-moving alts in a 401k plan. We don't need to debate the merits of that here if you don't want to. But again, these are just examples of the solution set is expanding really quickly, which I think is exciting for the industry. And again, scale players, we're going to be good partners for our advisors, vetting what are the right solutions under what circumstances, how do we support it? We'll bring it to market when we can fully support it, not just to be first. But as we come down the spectrum, what am I excited about an initiative? It probably is alternative investments, because there is a clear democratization wave that's underway. The structures and the pricing the sponsors have embraced the wealth management pool of capital as a strategic pool of capital they want to tap. What I really love is Cetera's ability through our Cetera Investment Management colleagues to actually vet the alternative investments that are being brought to market. And we will only make available through a modeled portfolio basis those asset classes and actual products that we think fit within a strategic asset allocation context. So, because what do we hear more and more from our advisors when it comes to AI? It's not our alternatives in this case. It's not just, hey, I need more and more CUSIPs to choose from. It's, hey, how can you help me put an allocation to private credit or private equity or private real estate in context of the strategic asset allocation that I've hooked my client household on? That's what we're doing through Cetera Investment Management. That's where I think you're going to get real acceleration of this democratization of alternatives, is when those alternatives are put in the proper asset allocation context. And so I'm excited about that. It also puts a further premium on financial planning. You got a planning-based relationship as an advisor with the households you serve. You got a lot of degrees of freedom of pretty cool stuff you're going to be able to do with them, including alternatives in a 401k plan, because it'll be done in a planning context. Hey, Jason, you can afford a little smidge of liquidity, even in your 401k plan, because look at the plan that we put in place for you. So I'm excited about that. When we speak in 5 years, Jason, I hope we're looking back and you're saying, wow, you really were the growth partner to the wealth managers, the wealth advisors that came to Cetera. I want this brand to be synonymous with growth partnership. I couldn't possibly have grown as fast as I did, but for being part of the Cetera community, the Cetera platform. And we're well on our way there. And I think 5 years is a good goal. We'll be able to look back and say, did we achieve that moniker or not?
I alluded to it. It was like a Pavlov thing in me with the dog with the little mints. Like when somebody says Cetera, I think growth. So it's working at least a part of the way there. You're getting there. This was great, though. Thank you so much, Mike. It's been an absolute pleasure. I love talking shop with you.
Likewise.
It's a really exciting time to be in our industry. I think you'd agree. And thank you again.
For sure.
Can't thank you enough.
Thank you very much. Have a good day.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.